Hi, and welcome to the Stockscores Market Minutes for November 9th, 2012. There is a bull market somewhere this week. I will show you how to find ways to make money from a market that is going lower. Before I get started, a quick list of upcoming events at Stockscores. There will be Stockscores club meetings in Calgary on Monday, November 12th, Vancouver, Tuesday, November 13th. You can register at the address you see there on screen. My new book, The Mindless Investor, will also be available. It is not yet in store, so this is one of the few opportunities you have to buy the book. I'll be teaching some courses in Calgary and Vancouver toward the end of November. You can get more information on those at stockscores.com/learn. There is a bull market somewhere. Even in a down market, there are some stocks and ETFs that rise. If you shorten the time frame to take advantage of stocks that do well while the rest of the market is falling apart. I'll show you an example of that in just a moment. You can also look to inverse ETFs, which go up when the market goes down. Now here's an example of a stock that I featured in my newsletter in the last week. It is MindSpeed, and what I have done here is broken this chart down into an intraday 15-minute chart. So each bar on this chart represents 15 minutes. While the overall market was weak, this stock made a break early on November 2nd, a break from an ascending triangle with abnormal price action and some abnormal volume, and that has led this stock to perform quite well considering what the overall market is doing. Here's the stock that's gone from 360 to 385, while the overall market has dropped pretty sharply in the last week. Of course, inverse ETFs are a way to make money from the market going down by buying these inverse ETFs. These, of course, will go up when the market goes down. In this particular case, I'm showing the ultra short QQQ ETF, which is symbol QID. It goes up about twice as fast as the NASDAQ 100 index goes down. And so if the NASDAQ goes down 1%, we would expect this ETF to go up 2%. Well, you can see that at the green arrow, this ETF broke its downward trend line from a rising bottom, and that has led to a nice little run over the last couple of weeks. Certainly better than owning the overall market, which of course has fallen quite sharply. All right, well, let's talk about whether the market is going to continue falling quite sharply. I am looking at 2-year weekly charts this week to give you that long-term impression of where the market is going. The first chart is of the S&P 500, and you can see that this chart has pulled back to that upward trend line that I have drawn in green, but it has not yet broken it. It's also important to note that the pullback that we saw this week, and really starting in mid-September, is coming from a new high and not from a falling top. That is a sign that the market should bounce here. Doesn't mean that we're going to move to new highs. We could form that falling top in the weeks to come, but in the short term, because we are at that upward trend line, this market is likely to bounce. The TSX is a much better looking chart because we've been building this cup and handle pattern. We're in the right side of the pattern now. We can see that there are rising bottoms on that chart. We're stuck under resistance at the red line, but relative to what the US markets are doing, the Canadian is holding up quite well, and that of course is likely due to gold and precious metal prices holding in fairly nicely, the Canadian economy doing better than most in the world, and that has this chart holding up while the rest of the world is suffering some losses. I'm a bit concerned about what I see in the Russell 2000 because unlike the S&P 500, this index has broken its upward trend line. Now the Russell 2000 is a representation of smaller cap stocks. Smaller cap stocks tend to be bought by smaller retail investors. And if you've listened to the financial news lately, you will know that the small retail investor is largely out of this market. And so I think this is really just a case where the demand for these small companies is relatively low because the typical buyers of them are not in the market right now. They are frustrated by what they see in the overall stock market. This chart is also a concern to me because it is of the 20-year Treasury Bonds. We've talked about this in recent weeks, and this week it broke up from that pennant pattern. Support at the green upward trend line held. What that means is that money is still seeking the safety of treasuries, and it is not running for cover, money is running for cover into those treasuries, and it is not coming back to the stock market. In recent weeks I had discussed the importance of watching this chart, because if we had gotten a break of that green upward trend line, that would imply that money was coming out of the sanctity of treasuries and back into the stock market. Unfortunately, we did not get that signal this week, and this is a bearish sign for the market. Another bearish sign for the market is the strength of the US dollar. The higher the US dollar goes, the more expensive US stocks are for people buying them with foreign currency. Of course, it's also more expensive to buy things like gold and oil and other commodities. So this is a concern if you are interested in buying stocks and commodities, and one more negative, making me a little bit on the bearish side for the market overall. Now, despite the strength in the US dollar, gold actually had a pretty good week, and that's really because people are looking toward more quantitative easing since Obama was elected. That implies that Bernanke will be around for a little while longer. Romney wanted to get rid of him. And also, there's just that uncertainty in the world with some sell-offs in the stock market, and we've seen some money come back to gold this week. Upside relatively limited. We've got that red line of resistance there, and I don't expect gold will have an easy time getting through that in the short term. Oil has tried to break the downward trend line this week. It failed, and I think it remains a bearish looking chart, likely to test that support at the green line on the chart. So my outlook then, neutral on stocks for US and Canada, but really at a critical point, particularly for US stocks, because they are testing that long-term upward trend line. I put a neutral rating on gold, probably has a little more upside in the short term. Oil, I'm bearish, even though it looks quite oversold. We just haven't seen a break of that short-term downward trend line yet, and so we must remain bearish. Stocks are threatening the long-term upward trend lines. In some cases, these areas of support are being broken. This puts the US markets on the verge of a trend reversal unless there is a bounce next week. I encourage you to be cautious, but typically markets do bounce from trend lines of support, and that may provide a short-term trading opportunity for those who catch the bounces in some of these really oversold stocks. We'll have a great week in the market, and trade well.